What's up, everybody? Welcome back to the stocktrades.ca YouTube channel. My name is Dan, one of the co-owners over at stocktrades.ca, and we've got another amazing video for you this week. Last week we went over a critical sector on the TSX, and that would be energy stocks. We didn't speak on very many producers, mainly because we don't really like very many producers right now, but we did include a ton of fuel options, pipeline options, natural gas options. So if you want to watch that video, I'll leave a link up top. But this week we're going to go over another critical sector here on the TSX, and that is financials, particularly bank stocks. I'm going to go over all big five bank stocks in this video, and with earnings coming up with these companies in the next month, it's going to be a critical period for them and the Canadian economy moving forward. So with that being said, let's dive into Canada's big five banks right now. So, major thing before we start looking at these banks, I've noticed that a lot of viewers on the Stock Trades YouTube channel are simply lurkers. Almost 60% of our viewers are not subscribers. So the only way we can continue to make amazing Canadian exclusive investment content is if we get more likes, more subscribers, more views. So before we start the video, smash that subscribe button and you'll continue to receive some of the best Canadian investment content. And if you like the video, at the end of the video, smash that like button. It really helps us rank in the YouTube algorithm, and again, more eyes on the videos. But let's get started with these bank stocks, and I'm going to go over them in terms of overall performance, the worst performers being first. So as a result, the first bank we run into is Scotiabank. So if we look at this year-to-date returns out of the five major banks, we can see that Bank of Nova Scotia has really struggled. They're still down on a dividend-adjusted basis, 22.1% year-to-date, while companies like Royal Bank, CIBC are down only 6.1 and 5.1% respectively. So before we get into the Bank of Nova Scotia's struggles, first, let's learn what they do. So the Bank of Nova Scotia was once called Canada's International Bank, but they've lost that title to the Royal Bank of Canada. For the most part, I can attribute a decent chunk of Scotiabank's underperformance to its overall failures expanding internationally. So although it still does have a strong international presence, it has struggled with recent synergies and as a result has significantly underperformed over the last 5 years. So in 2017, Scotiabank made over $7 billion in acquisitions. This, especially for a large cap Canadian bank stock, is a hyper aggressive growth strategy. It has since cooled down on this because generally it has been somewhat of a failure and it's really cost the bank in terms of top and bottom line growth, and as a result it is performing quite poorly. In fact, if I were to speak on the top five bank stocks period and not just focus on the five major bank stocks, I wouldn't even include Bank of Nova Scotia in this list. I would substitute them out for the National Bank of Canada, NA.TO. So Scotiabank operates three primary segments. They have their Canadian banking, their international banking, and their global banking. And even with its recent underperformance, it is still a huge bank, the third largest bank in the country. It's got a market cap of around $69 billion. And although the company does have strong international operations, most of them are primarily situated in Central and South America. So why are we looking at Canadian bank stocks? Well, it's primarily for their dividend. And although pre-pandemic, they still did achieve double-digit annualized returns over the last half decade, right now we can more than likely expect that growth to slow with COVID-19. So their dividends are top priority for a lot of Canadian investors. And as such, Scotiabank has become extremely popular. CIBC was the highest yielding Canadian bank stock for quite a while, but because of Scotiabank's underperformance, they are now the highest yielding bank. And as of right now, they're yielding around 6.4%. So the main question is the dividend safe? So in terms of payout ratios, we can see that Scotiabank typically hovered in the low 40 to mid 50% in terms of earnings. And as we can see at the start of 2020, the bank's payout ratio skyrocketed. So on a trailing 12-month basis, the company's payout ratio is actually in the low 80% range right now, which is the highest payout ratio in terms of big banks by quite a wide margin. So when a payout ratio gets into the 80% or higher range, we do start to get nervous, especially considering Scotiabank's payout ratio has come nowhere close to this for quite a bit of time. But it's pretty important that we do understand why Scotiabank and the other big banks' payout ratios are going higher. And this has a lot to do with provisions for credit losses. So I'm not going to go too in depth on what a PCL is in this video. If you want a great explanation, I'll leave a link below in the description. But essentially, a PCL, or a provision for credit loss, is money that a bank needs to set aside for loans that they expect to go unpaid. Not necessarily guaranteed that they'll go unpaid, but ones that they feel could in the future. And these provisions for credit losses need to be taken out of a company's profits. So how do we calculate a dividend payout ratio? It's the annual dividend compared to the company's earnings per share. So these provisions for credit losses being taken out of profits are inevitably going to shoot payout ratios higher. So the real question is, why did the Bank of Nova Scotia's payout ratio shoot higher than the other banks? Well, that is because they underestimated the effects of the pandemic in earlier quarters. And as a result, in its most recent quarter, the Bank of Nova Scotia had a significant boost to its PCLs. So while all other major financial institutions decreased their PCLs in the most recent quarter, Scotiabank's went up. So while a company like Royal Bank reported around $618 million in PCLs, Scotiabank's came out to a whopping $2.18 billion. And as a result of this, profits dropped drastically. When comparing year-over-year quarters, the bank's profits dropped from $2 billion to 1.3. Meanwhile, a company like Royal Bank reported a loss of net income of only 1%. Scotiabank has had significant setbacks in international countries. In Latin America, they went from posting profits in the mid $800 million range to actually posting a loss last quarter of $28 million. And this is primarily because countries in that region were exposed to COVID-19 later than, say, a North American country. Overall, if you're looking for a Canadian bank play, I would probably rank Scotiabank being the worst. Would I suggest going out and selling Scotiabank? No, I'm a current shareholder of Scotiabank. It just might take a while longer for this company to recover than, say, other big banks. And speaking of that, next up is our second worst performing bank out of the Big Five in Canada in 2020, the Bank of Montreal. So, Bank of Montreal, huge storied history with this company. It's paid uninterrupted dividends for 190 years. And you can probably tell from this why Canadians place so much emphasis, especially those looking for consistent income, on Canadian bank stocks. So the Bank of Montreal has four primary segments: capital markets, wealth management, personal and commercial banking, and Canadian personal and commercial banking. So the bulk of the bank's revenue does come from Canada, although it does have operations in the United States. In fact, the company is actually one of the top 10 commercial lenders in North America and is the #1 bank in Wisconsin. In terms of loans here in Canada, the company ranks number 2 as of March 2020, according to the Canadian Bankers Association. And the bank also has strong exposure in large US states like Arizona and Florida, and is continuing today to expand into California. Its loan balance has gone from $12.7 billion in 2010 to over $70.4 billion in 2019 in the United States. The company has a dividend growth streak of around 9 years. It started, much like all the other Canadian bank stocks, raising dividends once the '08 financial crisis had subsided. And they've grown their dividend by around 5.7% annually over the last 5 years, with its most recent increase actually topping this at 7.4%. And a really quick break here to explain a pretty critical point. Most financial stocks, especially these major bank stocks, it's kind of cloudy as to whether or not insurance stocks need to follow this rule, but major financial institutions in Canada have been strongly encouraged not to raise the dividend in 2020. So it is almost a guarantee you're not going to see any dividend growth from Royal, CIBC, any of the 5 Canadian bank stocks. And to be honest, that's probably a good thing, and investors should treat this essentially with that glass half full attitude. The most important thing throughout this pandemic is not dividend growth by the banks, but maintain dividend payments. So if we look at the company's overall yield chart, the Bank of Montreal has not yielded even close to this over the last 5 years. We can see in early October, it was yielding around the 4.5% mark. It dipped into the 3.5% mark in January, but now the company's yield is over 5% for the first time in a very long time. But how safe is the dividend in terms of earnings? And right now, the Bank of Montreal's looks a lot better than the Bank of Nova Scotia's. The Bank of Montreal, on a trailing 12-month basis, currently sits at a payout ratio of around 58%. And we can see historically, the bank has always kind of hovered around this range. We can see obviously in March, due to those PCLs, again, it spiked up above 100%. Overall, I really wouldn't be worried about Bank of Montreal's dividend payment at all. They won't grow the dividend, but it is very, very unlikely, although never impossible, like I've said before, that we see a dividend cut or a dividend suspension. So, valuation by Bank of Montreal. And actually on a price to earnings basis, the Bank of Montreal, despite still being down 17% year to date, which is nearly 3 times the losses of a bank like Royal Bank, it's still actually one of the most expensive Canadian banks. The Bank of Montreal is currently trading at a price to earnings of around 12.06. As you can see by the chart here, the only bank that is more expensive is Royal Bank at 12.39. So what exactly does this mean? They're one of the most expensive banks in terms of forward price to earnings, yet their share price has fallen quite steeply. Well, essentially, that means that analysts expect earnings to fall moving forward in 2021. That's essentially the only way the forward price to earnings can increase as its share price drops. So why the bearish attitude towards Bank of Montreal? Well, in my opinion, it's because of their exposure to oil and gas. Bank of Montreal is the bank with the highest loan book exposure to oil and gas. So Bank of Montreal, I own the stock, but do I feel it's one of the best bank stocks moving forward in 2020? No, I've reserved that title for another bank stock that we'll talk about last. But let's move on to our next bank stock, which was, prior to the pandemic, my favorite bank stock, and that is TD Bank. So if you're looking for exposure down in the States, TD Bank will be your bank. And for the most part, this has benefited the company immensely over the last 5-10 years. However, due to COVID-19, that situation has changed quite drastically. I'll speak on that later. But in terms of TD Bank, they are the second largest bank in Canada in terms of market capitalization. And south of the border, and actually in North America in total, they're the 6th largest bank by market capitalization and the 5th largest bank in terms of total assets. The company has over 90,000 employees and operates in 3 primary segments: Canadian and US banking and wholesale banking. So in terms of dividend, how does TD stack up? Well, prior to the COVID-19 pandemic, if you were to ask me what the best dividend stock in the country was, I would probably tell you it was TD Bank. In terms of 5-year dividend growth rates, they had the fastest growing dividend out of all 5 banks at 9.7% annually over the last half decade. I think the only one that comes close to this was RBC in the 7.5% range. A near double-digit dividend growth rate out of a major financial institution like this is great. And also in terms of share price, they were one of the fastest growing banks in the country as well. So in terms of payout ratios, the dividend, in my opinion, is safe. TD Bank's payout ratio has jumped a bit due to the COVID-19 pandemic. In fact, they actually sport the 2nd highest dividend payout ratio out of all Big 5 banks. They're second only to Bank of Nova Scotia, but it still sits at the 65% range, which historically is higher than usual but we have to understand that we are in the midst of a global pandemic right now. The company's yielding 5+%. This is the highest TD Bank has been yielding in quite some time. And realistically, this is a great opportunity to get into a bank that is trading at the cheapest levels it's been since the 2008 financial crisis. TD Bank is trading below its 5-year historical averages on a forward price to earnings, price to book, and price to sales level. And the reason for this is more than likely its exposure to the United States. You probably know that the epicenter of COVID-19 right now is in the United States. Cases are growing at a faster rate than we've seen ever. And despite the fact that the United States is not really shutting down on an economic level, people are still scared to go out and spend money, do things like eat at restaurants, go to movies, things like that. The economy is going to struggle as long as COVID-19 runs rampant in the United States. And as such, TD Bank is still down, I think around 17% year to date. But next up, let's move on to CIBC, which is actually the only Big 5 Canadian bank stock that I don't own. So CIBC is the smallest Big 5 bank in terms of market cap, but it's important that you understand that this is still a massive company. It's worth over $45 billion today, and it's actually still one of the largest stocks on the TSX index. The stock has long been the beneficiary, or investors have been the beneficiary of it being the highest yielding bank stock on the TSX. So CIBC operates in 3 primary segments: their retail and business banking, their capital markets with CIBC Investors Edge, and also their wealth management. And CIBC is the highest exposure to the Canadian economy out of all Big 5 banks. The vast majority of its over 11 million personal and business customers reside right here in Canada. And this is one of the main reasons why I avoided the company, because I didn't like their exposure to the Canadian economy over the last while, which has paled in comparison to the growth of the economy in the United States. So CIBC has performed admiringly well in 2020, despite its earnings dropping quite a bit actually. Profits in the third quarter of 2019 were around $3.06 a share, and in the third quarter of 2020 they dropped to $2.55 per share. So the company did see a loss, not as drastic as a company like the Bank of Nova Scotia, and the overall outlook, according to CIBC, is actually quite positive. They essentially blame the loss in profits to, again, provisions for credit losses, which when at its peak during COVID sat at $1.41 billion. They're down to around $525 million in its recent filing, but this is ultimately going to affect the company's bottom line. They've also stated that exposure to low oil prices has also harmed them in the short term. But oil prices have recovered somewhat. They're seeing lower requests for things like mortgage deferrals. And overall, the company actually has a positive outlook moving forward. And obviously, so do Canadians. I mean, this is a stock that has kept up with RBC and is actually the second best performing bank in the country here to date, and is outperforming the TSX index. As I mentioned before, CIBC had long been deemed the highest yielding bank stock. Poor performance by Scotiabank has nullified this, but they still have a 5.8% yield, and they pay an annual dividend of $5.80 per share. And obviously dividend growth expected to stall, but when we look at CIBC on a payout ratio basis, trailing 12 months in terms of earnings, they have a payout ratio of only 57%, which is the second lowest bank next to Royal Bank. Overall, this dividend seems safe, and although growth will stall, investors can collect a 5.8% yield on CIBC moving forward. So on a valuation basis, CIBC again is one of the cheapest bank stocks out of the Big 5. It's trading at a forward price to earnings of 11.57, price to sales of 2.4, and a price to book of 1.2. So even with this recent surge in performance, would CIBC be a bank stock I'd be looking to buy today? I would say no. I still have no plans of owning the company. I would much rather prefer TD Bank, Royal Bank, and National Bank, but I still feel there'll be a stronger option moving forward than the Bank of Nova Scotia. The only issue I have with CIBC right now is, again, their exposure to the Canadian economy. And again, this isn't a list of the worst to the best. This is simply a list of worst performing in 2020 to best performing in 2020, which our next stock, the best performing bank stock in 2020, and my favorite bank stock moving forward, Royal Bank of Canada. So if you ask any other Canadian where they bank, where they hold a credit card, a mortgage, there is a very, very good chance that they're going to say the Royal Bank of Canada. And that is because it is the biggest bank in the country. Royal Bank of Canada overtook Scotiabank as the most globally diverse company as well. It has operations in over 40 other countries, which I'll explain in a bit why this has helped them outperform the other major banks drastically. Royal Bank is one of Canada's strongest brands. It's actually been deemed Canada's strongest brand for, I think, the last 6 years. It is the second largest company in the country next to Shopify. And an interesting tidbit about this, last year, Royal Bank paid out more just in dividends than Shopify had in total revenue. So you can definitely understand the sheer size of this bank and the sheer cash generating machine that it is. Royal Bank is the poster boy when it comes to blue chip dividend stocks here in Canada, and it has over 83,000 employees across the globe. So at the time of filming this, Royal Bank has the lowest yielding dividend out of all major Big Five banks at 4.44%. And this is primarily because its stock price has held up so well in relation to the other banks. On a year-to-date basis, Royal Bank is actually only down 6.3%. If we compare this to the TSX, which year-to-date is down only 4.6%, this is a very good thing. This is a financial company that is seeing things like mortgage deferrals, economic shutdowns, ultra-low interest rates. They're keeping up with the recovery of the index while stocks like Bank of Montreal and Scotiabank are falling drastically. So it's not the highest yielding, but again, don't get tunnel vision when it comes to yield. This is the best dividend stock out of the Big Five banks. In terms of payout ratios, the company has actually returned to its historical payout ratio, which is in the mid to high 40% range. And again, it's got an 8-year dividend growth streak. It's grown its dividend by around 7.5% annually over the last 5 years. And interestingly enough, although the Royal Bank of Canada will be forced not to raise its dividend in 2020, I'm actually pretty confident that if these rules weren't put in place, Royal Bank would have been completely capable of raising the dividend even in the midst of this pandemic. And primary reason for this is the fact that the company had an outstanding third quarter, all things considered. So we're in the midst of a global shutdown, low interest rates, everybody's struggling. We expect the banks to struggle as well, right? Not really. They posted earnings per share of $2.23, which if we look at 1 year ago today, that is only 3 cents lower. And in terms of revenue, the company posted revenue of nearly $13 billion, which is an increase from the $11.54 billion range 1 year ago in the third quarter. Now, the main drivers for growth the company attributes to a strong housing market, which might actually continue moving forward in North America, especially considering the interest rates we're seeing. But it also has to do that the company fueled strong growth from its capital markets segment. So many people during this pandemic were opening up brokerage accounts and starting to invest. So as a result, RBC was driving commissions, new accounts in this segment, and they've seen a lot of growth. But one of the primary drivers for the company to be able to maintain this revenue and earnings is the fact that it does have global exposure in over 40 other countries. So with global exposure, the company was exposed to a much broader scale of COVID-19 shutdowns. In one country, they may have been just starting out, whereas in another company, they might have been recovering and the economy was opening back up. They weren't hit as hard by a company like, say, TD, who has nearly 1/3 of their revenue in a single country that is effectively the epicenter of the virus. They've been able to be exposed to a lot of different countries, that are recovering from COVID-19 at a different rate. In fiscal 2019, the company profited $416 every second. And yes, you heard that right. This isn't revenue, this is profit. $416 every single second. This is, in my opinion, going to be the best bank moving forward for the short term, the midterm, and the long term in Canada. It is one of the largest holdings in my portfolio, and the ability for the company to generate such strong cash flows and post such strong third quarter earnings in an economic crisis we have never seen before. I really have a ton of confidence in Royal Bank moving forward. So that's pretty much it for the video, everybody. I really hope you liked this video. I hope it brought a lot of insight into Canada's financial institutions, where their dividends are headed, where they're headed in terms of growth, and my overall outlook on all five. Again, this list is in no particular order. I simply went by the worst performing bank in terms of stock price up to the best. But that being said, Royal Bank, in my opinion, is the best bank stock to be looking at moving forward. In fact, I think it's one of the best stocks, period, to be looking at in Canada. Again, like the video, subscribe to the channel. No more lurkers. 60+% of people do not subscribe and they watch our videos. The subscriptions really help not only us get more views, more likes, more traction to the channel, but it also lets you know when we publish more great content on Canadian stocks. We'll see you next time.